Hi, this is Jordan. Jordan is an investor at Wall Street. As Jordan is constantly searching for lucrative investments, Jordan reads on the web about a firm called Pineapple. Pineapple is a private company that designs, develops, and sells consumer electronics like computer software, personal computers, and mobile phones. Pineapple has survived a challenging startup phase and has now reported several quarters of significant growth. However, to keep up with the growth, Pineapple needs more capital, so therefore it has announced to go public. Jordan is interested, however, as he's not familiar with this company, he is uncertain about the precision of Pineapple's reported earnings. Jordan therefore doubts whether he should invest in Pineapple. To help Jordan investigate this, insights can be given by the paper Learning, Precision Uncertainty and a Time Series of Earnings, which is written by Hollander. The paper first investigates how investors learn about the time series parameters of earnings. The time series parameters of earnings is how investors use past earnings to estimate future earnings. The parameters of a firm's earnings distribution can be defined as the drivers of the firm's earnings. Hollander expects, consistent with rational learning models, that the uncertainty about the time series parameters of earnings decreases as the firm's earnings history lengthens. This hypothesis is based on the expectation that investors are initially uncertain about the parameters of a firm's earnings distribution, since there is relatively little information available about newly listed firms. Hollander expects that this uncertainty will decrease over time as investors are able to learn by observing past and current earnings. However, he predicts that the learning process is made more difficult by noise and uncertainty. The second hypothesis is therefore that the speed of learning depends negatively on the variance of the noise in reported signals. This means that when newly arriving information is of uncertain precision, investors are likely to place less weight on this information. Therefore, noise makes it more difficult to learn about a firm's earnings distribution parameters. The paper furthermore builds on the findings of D'Angelo, 1981, who suggested that larger, more reputable auditors have incentives to provide high-quality audits. This is because they want to protect their reputation and decrease their exposure to litigation. These incentives to provide high-quality audits may consequently reduce investors' uncertainty regarding the precision of reported earnings. The third hypothesis is therefore that large, more reputable auditors can reduce the precision uncertainty of reported earnings. Since precision uncertainty is an example of noise, and noise is expected to be negatively related with learning, the main hypothesis of this paper is that ceteris paribus, learning is faster when firms are audited by large, more reputable auditors. The results of the paper are based on a large matched sample of US common stock IPOs and show the following results. Investors are able to use past earnings to rationally infer parameters of the underlying distribution of earnings. The results indeed show that the uncertainty about the time series parameters of earnings resolves gradually over time as longer series of earnings become available. The second finding is that the learning process is slowed down by noise and precision uncertainty. Thirdly, Hollander found that the magnitude of the stock price response to earnings declines significantly more over time for newly traded firms audited by big auditors than for newly traded firms that are audited by small auditors. This indicates that investors who hold stocks of firms that were audited by a large auditor learn at a faster rate than investors who hold stock in firms with a smaller auditor. This consequently implies that large auditors turn out to be better able to reduce investor precision uncertainty compared to smaller audit firms. These empirical results are obtained from Table 5, which shows that the found values have the same sign as predicted. Let's go back to the example of Jordan and Pineapple. As Pineapple wants to increase its capital at the lowest possible cost, Pineapple has significant incentives to overstate its reported earnings. However, since Pineapple is still a private firm, investors do not have much information about Pineapple. It is therefore difficult for Pineapple to convince potential investors such as Jordan about the reliability of its reported earnings. As a solution to this problem, this paper suggests that it is advisable for Pineapple to contract a larger, more reputable auditor, as this will help Pineapple to reduce the precision uncertainty among investors about Pineapple's earnings. A lower level of precision uncertainty increases the likelihood that investors such as Jordan will invest in Pineapple. So contracting a large reputable auditor increases the likelihood that Pineapple attracts sufficient capital to expand.
created using Powtoon.